fact, let's discuss this and a lot more with our next guest on the show. Our market master of the day is joining in, Sandeep Bhatia, head of Equity India and country head India at Macquarie Group. Sandeep, great to have you with us on the show. Thank you very much for joining in. So, well, yes, the old saying goes that markets can stay higher a lot longer than the mind can stay rational. I don't know if we are in that scenario yet or not. But what do you make of things? I mean, this exuberance at the index level, PSUs, CapEx, the whole construct and structure at this point.
Yeah, it's a lovely monsoon outside my window and it's a lovely market in front of my screen. So fantastic.
Lots of green, right? Outside and on the screen.
Correct. So just to answer your question, yes, I think we are at very rich valuations. I think in the near term, these rich valuations can sustain. Some of the data which is coming from the US is talking about inflation coming off. Our view has been that structurally there are three markets which are in a bull run, US, Japan and India. Not in that order necessarily. So I think, yes, India is on a good wicket and continues to be on a good wicket. The only thing which actually makes one pause and think is that I think earnings, while strong, I think the earnings revisions will be actually peaking out in this year. So if we don't see earnings revisions, there's definitely going to be headwinds, post-budget. And thereafter, there could be definitely some headwinds, but it's not unless there is a black swan event, which is unpredictable by its very definition. We are in a good market, which can give you still around single-digit returns till the end of the financial year.
Okay, Sandeep, looks like the monsoons have sort of uplifted your mood as well. I mean, good to see you, good to hear from you after a while. Thanks for joining us. The sector that everyone's talking about now is IT, primarily not because of the growth, but mostly because it's been such a laggard and now things don't seem as bad as they were about 12 months ago, right? Do you think it's a good time to be increasing your allocation in IT, especially after what TCS reported?
Yeah, I think you hit the nail on the head here. And clearly, I think IT is not being a favorite sector. There are many, many reasons for that. It's the US political cycle. It's the US interest rate cycle. It's the domestic economy growing fast. So why would I want to play, international IT spends, so on and so forth. We just discussed in the answer before that I think domestic earnings upticks are going to get difficult. And interest rates in the US can come off. So I think IT is good to play. We like Persistent. We like HCL. Tech, we like TCS. So yes, would stick with broadly the larger cap names.
Okay, hi Sandeep. Good morning and good to see you in. This is Nigel on this side. Well, I recall you were quite positive on private sector banks, and HDFC Bank. I think you had hinted that it could be the dark horse. It did very well. From March till the last week, the stock was one of the big outperformers. From its low in February, it was up more than 25%. But now it's pulled back a little bit. What's your take on HDFC Bank? Because that got the technical factor moving for it. But the operational update that did come in.
Thank you.
Yeah, but the operational update wasn't that great. Yes. What do you do with it? Is that still a stock that you would believe will do well from here on and most of the bad news is in the price?
So the technical factor in favor of HDFC Bank, which is the MSCI inflows, we expect around $4+ billion to come in at the end of August. That technical event still is to happen, and that should happen. So that will definitely be a technical reason for the stock to move up. But you're asking about operational fundamentals, business drivers. So I think here, it shouldn't be a standout negative outperformer. There have been issues around its tech, which has basically dampened the spirits. It's not seen to be the unsinkable stock that it was. It's still very much an unsinkable bank, but definitely not necessarily the unicorn kind of a stock. So I think in the banking sector, I would still be positive on HDFC, but we currently do like Axis and IndusInd Bank also. So we have moved a bit away from our extreme overweight we had when the stock was down in the dumps on HDFC Bank. But I think there is also a value to come through in the public sector banks. So we like SBI. And if this interest rate cycle and we have a broadly responsible budget and on the 23rd of July, if interest rates are seen to be coming off both in India and in the US over the next 6 to 12 months, I think both public and private sector banks can potentially do well. One thing is for certain, the investment, the NPA cycle and the bad debt cycle, we are not seeing any of that. So the broader economy, the credit worthiness of businesses and individuals remain very strong. So banks should outperform.
Okay, so still positive on banks, but maybe a little bit of a favorable tilt towards the PSUs like SBI. Got it. Just to clarify that point, you said that the market may still give single-digit returns by the end of this year, or are you saying 2020, end of the financial year? Okay, yeah. Okay, got that. So, now I want to really draw your attention to, I think, the biggest momentum trade, should I call it investment or trade, or that we've seen in the last many years. I wasn't around in the late 90s to see the IT move, but I saw the infrastructure trade between 2004 and 2008. And here we are looking at the mother of all PSU, CapEx sort of themes and that big trade. What's your sense? Where are we in it? Does it still have legs and room? Because there's no point betting against it. Anyone who's been betting against it has been absolutely left out in the cold. So what should we be doing now?
I think great question. Comes down to the simple fact that India's corporate sector has time and again made a mess of its banking sector. And both are completely interrelated. We saw that in the last down cycle in the markets. It started with IFL and it spread across housing finance companies and so on. The corporates were anyway over-leveraged going into that bad event. But now, as things today, I think both in terms of the scrutiny, supervision from the Reserve Bank, and the fact that the promoters are assured of one thing, is that they will definitely face the NCLT and they will be stripped of their assets before they can strip the assets from the companies. And that means that generally the corporate sector is seen to be more kosher in its capital investment decisions and not get over-leveraged like it did in all previous cycles since the 90s when India liberalized. So to cut a long story short, yes, infrastructure boom is happening and should continue to happen. The only thing I will say is that look out for the macro and look out for the bad debts if they build up. Then this infrastructure boom can come off for both PSUs and in the private sector and in the real estate sector and across the board. That's not happening as we have already discussed. Credit worthiness, both of corporate and individuals, remains solid going into the next couple of quarters, and we can continue to play this.
No one's arguing against that, Sandeep. My question is more from the point of view of just PSUs, and I don't know. I mean, is this beginning to look like a bubble, or is it still justified because some of the companies are still reporting decent earnings, but stock prices have run up 300, 400, 500%. So specifically on PSUs, is there something that you would still back?
Other than the PSU, the banks, I would be careful about this. But, honestly, Macquarie coverage is not as wide in that sector. So for me to say something with solid research backing is going to be a bit difficult. So the PSUs are richly valued. They came from an extreme undervaluation now to historical highs and never seen before highs. That can continue as a liquidity event. Fundamentally, unfortunately, given no coverage on those names, it would be difficult for me to actually give a view.
Okay, by the way, the market is really piling on the gains now. I mean, just look at that. 100 points higher on the Nifty, almost 300 points higher on the sensex. And lots of individual stocks, right? Our ONGC, by the way, is at a fresh 52-week high. So keep an eye out on that. Federal Bank is at a fresh 52-week high as well. And a couple of other stocks, Zomato we spoke about, that's been doing quite well this morning. And then you have some of the other names. Sandeep, before we let you go, the big event upon us is the union budget. And this time around, the common narrative is that given the higher RBI dividend, given, there's more fiscal headroom, perhaps the government could please everyone with, a growth-oriented budget, maybe some populist measures as well, and keeping the fisc in check. Do you think that's something that the street has priced in already?
When you try to please everyone, in the end, you please no one. The faster we realize that, the smarter we will be. So to answer your question, I would think that this would still be a fiscally responsible budget. There is no real pressure to do anything, even though there are some important state elections coming through in November, December. I don't think giving something in the budget can change the outcome on elections in any of the states which are important to the BJP. So I would expect it to be a fiscally responsible budget. If it is actually seen to be a populist budget and giving away freebies right after the elections that just ended less than a quarter ago, just last month, it would actually show weakness in the government. So I would actually look out for that and take that as a negative message if there's populism.
Okay, Sandeep, have a great weekend. Always fun speaking to you and trying to understand which way the market is headed. So hopefully we'll speak again soon.